Hey friends, it's Adrian and welcome back to the channel. So commercial real estate is one of those industries where it's like being in a different world.
I don't know what you're saying!
Because the people in it speak a different language. In this video, we'll go over the most commonly used words in the industry. So next time you speak to a broker or another investor, you'll know how to respond instead of just standing and smiling.
Just smile and wave, boys.
Now, there are a lot of terms in the commercial real estate space specific to lending, legal, or accounting. But let's be practical. There are terms you use more often than others. So the terms I'll be explaining will be the ones we use for underwriting. And we'll actually be using an underwriting model so you can see how the term is used. Alright, let's jump right into it. This is an underwriting model. There are a lot out there. This is just one of them. Regardless of what you will use, it will all be similar. So let's start at the top line. The gross potential rent, or GPR, is defined as the maximum amount of annual income assuming all units are rented at the market rate. Now, when you add other sources of income such as parking fees, pet fees, laundry, etc., that is your gross potential income. Let me just say this, it is very unlikely for all units to be 100% occupied for 12 months renting at the market rate. So what is the purpose of the gross potential income, you ask? Alright, let me tell you a quick story. Remember back when you were in school and the teacher was calling for attendance? The easiest way to keep track of the class is to have a master list of every student that is supposed to be in that class. That way, the teacher will be able to identify who's missing and who doesn't belong in the class. The gross potential income is your baseline. It is your master roster for every dollar that belongs to that property. Alright, now let's account for all those missing dollars. Let's start with vacancy. It refers to an unoccupied unit or space in a rental property. To be more specific, it is called physical vacancy. Just because a unit is occupied, it doesn't necessarily mean that the tenant is paying rent. That kind of vacancy is what we call economic vacancy, and that is a more accurate measure of accounting for missing rent. You can find the economic vacancy in the rent roll under the balance column. Next is the loss to lease, or LTL. It is the difference between the actual rent and the market rent. This is an important metric if you understand the definition. In layman's terms, this is the money left at the table. Some of the reasons why the actual rent is less than the market rent may be due to concessions that the operator is giving to the tenants as incentives to have the units occupied. Another is maybe rents is rising quickly from when the leases were signed. Whatever the reason may be, this is a simple value add to the overall business plan. Alright, let's move on to the effective gross income, or EGI. It is the difference when you subtract vacancy and loss to lease, or L2L, from the gross potential income. This is an essential metric as well because this is sometimes called the true income. The EGI is also a number you need to solve for the net operating income, which we'll cover later on in this video. Let's move on to the operating expense, or OPEX. As the name implies, these are costs that go into running the property, which are these items. More often than not, the biggest line item here is taxes. Each state and/or county calculates that differently, so be sure to ask the tax assessor's office for the property on how it is calculated. Operational expense is straightforward, so instead, let me explain what it does not include. OPEX does not include debt service, CapEx, or capital reserves. Now we have everything we need to cover the most important metric of them all, the net operating income, or NOI. This is a metric used to measure how profitable a particular investment really is. It's very easy to calculate. NOI equals effective gross income, or EGI, minus the total operating expense, or OPEX. The NOI is also used to determine the property's value, and the formula to get the value is value or price equals NOI divided by the cap rate or capitalization rate. The topic of cap rate can be a video all on its own. Actually, I made a video just explaining cap rates. The link is in the description below. Check it out after watching this video. By the way, if you found value in this video and want me to cover more terms, type in the comments which term you want me to go over next. The last term I'm going to cover is the preferred return. It is also referred to as the PREF. Preferred return is a portion of the profit distribution either from cash flow, refinance, or sale that is distributed first to a certain member class. In most cases, it is the limited partners or passive investors. This term is commonly confused with guaranteed. Preferred return is not a guarantee. It means the passive investors get paid first before the managing partners get paid. So don't be misled by an operator who tells you otherwise. We pretty much covered the most important terms. I recommend going over other terms that have close relations to the terms that we just covered. As you discover more terms and familiarize yourself with them, you might think, this isn't so difficult.
I can implement these myself.
Well, before you go calling brokers and acquiring your first apartment complex, there's a lot more to becoming a general partner that goes beyond the spreadsheet. spreadsheet. It's not as easy as what most people claim it to be. So watch this video next where I go over what a general partner goes through, and I'm not even gonna sugarcoat it.